FedEx is seen as a global economic bellwether for very good reason. Yet it became the latest corporate giant to refuse to provide guidance for the rest of this year. And the reason why is the confirmation and the huge warning that we're getting on consumer spending and especially consumer incomes. And while everyone is quick to blame trade wars and tariff uncertainty, the truth is, as I keep telling you, the U.S. economy is becoming more, not less, certain. Despite all the assurances consumers were only pessimistic because they were overreacting to tariffs, the hard data instead keeps confirming that was never the case. And we can visibly see the inflection right from the start of this year, meaning this didn't just happen last month or in April. Consumer spending and especially incomes are down in a way that we haven't seen since 2020. Yeah, 2020. I'll bet you haven't heard that anywhere, even though what we're talking about is basically the holy grail of macroeconomic statistics. This is why prices haven't jumped despite a rise in input costs. That much, anyway, is absolutely happening. There has been, and there will continue to be, a jump in materials costs for all sides of the economy, services as well as goods. And we got even more evidence to that effect today from Chicago, where backlogs in Chicago hit a near record low. That's because no one can pass any of these higher charges all the way up the global chain to consumers. You want to know why these corporate titans like FedEx and others don't want to provide any guidance? This is it right here. They know what happens if consumer spending continues on the way that it is, what that will mean, especially with rising input costs. They know where this leads. This leads to a summertime where we don't just have a few sprinkling of layoffs that we see now in the labor statistics. They really do start to accelerate. And so companies don't want to provide guidance because they don't want to have to admit, if this continues to go this way, that's where everything is heading. It's more evidence, the holy grail evidence, for this transition to the flat part of the Beveridge curve. We just got a whole bunch of it, starting with what FedEx didn't say. They had already spooked the stock market last week when they refused to provide any guidance for the rest of the year. And as Bloomberg said, FedEx warned that its profit would be worse than expected this quarter and then declined to offer guidance for the rest of the year. Although it typically provides a full year forecast, FedEx said that it would only share its outlook for the current quarter due to the, quote, uncertain global demand environment. As I keep saying, it's getting more certain, not less. It just doesn't look the way that most people want it to. And the forecast assumes that there's no further negative developments in global trade dynamics. It's really the fragile economy. Investors were concerned, quote, after management did not provide an initial full-year outlook for the only time over the last 13 years. That was from JP Morgan analyst Brian Ossenbeck. And then Morgan Stanley's and Jefferies analysts also said that withholding guidance spooked Wall Street. At least the one part of Wall Street that may still care about macroeconomic circumstances while everyone else is off chasing the AI bubble and Mag 7 and the NASDAQ and everything that goes along with it. Instead, the macroeconomic outlook continues to be as dark as it was before. As FedEx's own chief customer officer said, U.S.-China shipments, which is the company's most profitable trade route, that deteriorated sharply. That's the term she used, deteriorated sharply in May, and volumes are expected to remain under pressure moving forward. That's the thing. It's not just a one-time thing. It's not just weakness in a couple months around April. This thing is continuing moving forward in all of these various dimensions. Consumer spending and incomes, as we'll see in just a second, but also these companies who realize the economic circumstances that all of this stuff is taking place in are less than ideal, to say the least. They don't want to say what it is because they know what that means. For FedEx, as CNBC reported, it's already been a tough year to begin with. Their revenue for the fourth quarter was basically flat to the fourth quarter a year earlier, $22.2 billion compared to $22.1 billion. For the full fiscal year, revenue was again flat, and these don't account for price changes. $87.9 billion compared to $87.7 billion. And as CNBC points out, FedEx and rival UPS are typically seen as bellwethers for the global economy since they touch a wide variety of businesses. It's not just goods economy, also services. But here's the thing with FedEx that goes along with the flat part of the Beveridge curve and the possible transition. When faced with difficult economic circumstances, you can't grow revenue, costs are rising, you start cutting your own costs. Maybe you don't want to let go of employees, but what do you do before you have to let go of employees? You start cutting back on capital expenditures. That's one thing you can control. And if that doesn't work, then you go the next step. And as CNBC reported too, FedEx said its capital spending for fiscal 2025 was just $4.1 billion, down a whopping 22% from the $5.2 billion in fiscal 2024. And capital spending as a percentage of revenue hit its lowest level in FedEx history, according to the release. So FedEx is already in cost-cutting mode, in dramatic cost-cutting mode, in response to the weak environment before we even get to tariffs. And now looking forward, first of all, from the second quarter perspective, they already said it's not going well. We don't want to give you guidance because today where we are, not good to begin with, and we don't think it's going to get any better. And there are all these warning signs that it could actually go a lot worse from here. So they're using the cover of tariff uncertainty to say basically nothing. Better to say nothing, keep your mouth closed, than to say something that's going to prove what the economic data already has. Before we get back to the rest, I want to let you know that Eurodollar University is having an anniversary sale and webinar. The webinar is coming up on Thursday, July 10th, 6 p.m. Eastern Time. There's a link in the description of this video to sign up and attend. On top of all that, we're going to have our best prices on all of our subscription products. In fact, we're launching a new subscription product, which I'll tell you about down the road. Like I said, if you want to join us for our webinar on July 10th, link in the description to sign up. I do hope to see you there and everything else. So that brings us right to the holy grail of macroeconomic statistics, the income and spending figures from the Bureau of Economic Analysis. The BEA, same folks who put out GDP, and already showed us in first quarter GDP that consumer spending was basically flat and flagging then as well. Now we get the confirmation that weakness wasn't just weakness, it got worse and continued on here in the second quarter. And you know the story already, the story that we've been given from the beginning of the year. We can dismiss the very bad pessimistic consumer sentiment figures as a bunch of worry-wart Americans who are overreacting to tariffs. You can almost hear them say vibe session when they're dismissing all of this. But consumer sentiment, that's more about employment perceptions than tariffs or really even prices. It's about job opportunities and income potential on the good side and job security and threats to income on the bad side. And if there was any response in consumer sentiment to tariffs, it was understanding how higher costs would put their jobs and their incomes into further jeopardy. And that's what the data has showed. Incomes were already suggesting trouble before we ever got to tariffs. But the latest figures we have for May 2025 show that overall nominal income, personal income, this includes basically everything across the economy. Total personal income in nominal terms fell, absolutely fell, outright fell by 0.42% month over month in May. Now, a lot of that had to do with some stuff going on in Social Security, both positive and negative, a little bit of Doge cost cutting. But before we even got to May, earlier this year in January, the outgoing Congress and the outgoing Biden administration, they signed the Social Security Fairness Act, which on January 5th eliminated the windfall elimination provisions as well as the government pension offset to Social Security payments. So they were going to start making retroactive payments in February, but it really ramped up in March and April. And what it really said was that some public servants, largely teachers and firefighters and similar, who either hadn't paid into Social Security, therefore they're ineligible to receive Social Security, or they were getting pensions and some other benefits from other places, therefore previous Congresses had eliminated the double dipping. The Biden administration said we're going to eliminate those eliminations, therefore you get all these Social Security benefits that according to the Biden administration, you should have been getting all along. And so in February, March, and especially April, Social Security paid out a lot of payments, not just moving forward, you're going to get more benefits, but also all of those payments that weren't paid backwards that are now eligible under the new law, they paid them all at once. And so you see a huge, and I mean huge increase in Social Security transfers, March and April, a whopping $163 billion seasonally adjusted annual rate, or an 11% surge in those 2 months in Social Security transfers. Now, the funds weren't spent. They all went into savings. At least that's what the rest of the personal income and spending data shows us. And then we get to May. May, we see Social Security payments decline by a whopping $122 billion, as a lot of those retroactive payments have been made. Therefore, it's Social Security overall is going back to where it should have been without those past payments coming up. You also have a little bit of an effect from DOGE weeding out fraud in Social Security payments. But now we have this one-time distortion, and it was a big distortion across all the income numbers. As that distortion fades, what we see is that when you adjust for those transfer payments and look at just private income, again in nominal terms, nominal private incomes were down in the month of May of 2025. They fell by a 0.08% rate on the month, which is the first monthly decline since January of 2022. And it's the only one so far in the 2020s that's not associated with the pandemic and the lockdowns in some ways. In fact, without the pandemic and lockdowns, you have to go all the way back to December 2019 before you get a negative month in nominal personal private incomes. In fact, there was 3 negatives in 2019, which goes along with the fact that that was the last time we saw a recession scare in the economy. Nominal private incomes are weak. The overall economy experiences more trouble. And we look at just wages and salaries, that part of nominal private income, because nominal private income includes things like proprietors' incomes and some other items. We look at just wages and salaries. Those are slowing down with the overall trajectory in the marketplace, well, the labor marketplace as well. Private wages and salaries, again, nominal terms, rose at a 4.6% year-over-year rate in May, but that includes some of the artificial high from last year, which did show up in income. So if you look at private income on a 3-month basis, it's about 1.4%, which is clearly slowing down from last year's artificial high, which peaked around December. And then when you adjust for price changes, so you have real personal income excluding transfer receipts, that was negative in the month of May for the 3rd time in the 5 months of 2025 so far. So we got 3 of 5 months with negative real income growth outside of transfer receipts. And when you look at a year-over-year change, it's down to a 1.5% rate, which is slowing back down after the artificial high last year. So Jay Powell and all the media says consumers are worried about tariffs and it's an overreaction to them. It's nothing more than negative sentiment. We'll wait till we get confirmation in the real economy that's actually altering their behavior. What we see is that consumer sentiment that we know is linked to especially jobs and incomes. The income data says that they had every reason to be concerned by the time we got to tariffs because something has changed fundamentally in 2025, especially when you adjust for prices. As we know, consumer incomes have not kept up with price changes. Already being left behind, the tariff threat, as much as there was one, was first of all a threat to incomes not being enough to keep up with price changes. And if there are any more price changes, it's going to leave everybody even further behind. But mostly, consumers know with the income environment as weak as it is, that means the labor market is already weak, which means any further increase in prices for businesses and employers will have to lead to adjustments by those businesses and employers that create job losses, hour losses, threats to job security and incomes. With that background, it's not surprising that we see that consumer spending has already changed. It's not just sentiment. Consumers have already altered their behavior in terms of spending, and here we have the proof for it. What the BEA shows is a very clear change in trend that started in the month of January. Remember back in January, we pointed this out with retail sales. Retail sales were down big in the month of January, which everyone dismissed as it's a one-off anomaly or aberration. But as we continue to move forward, we see that it's more durable than just the 1 month or the 2 months, and it's much broader than just the goods economy. We see this going into services, which is the takeaway from the GDP revisions from the first quarter. So here in the month of May, real personal consumption expenditures, which includes everything, anything consumers spend on goods or services, down by 0.28%. So down a solid rate in the month of May. And like incomes, that's the 3rd negative out of the 5 months of 2025 so far. And the 4th of those 5 was very close to 0 to begin with. And the 5th one, the last one, was the March high that was based on a whole bunch of consumer spending on automobiles as consumers were afraid automobile prices were about to skyrocket under the tariff regime. So again, a very clear change in trend in consumer spending already, not some future risk. This is already happening. And we look at 2025 so far on a 5-month basis, Real spending is down 0.17% for a 5-month period. Real spending is down for the entire year of 2025 year to date. We haven't seen something like that happen since July of 2020, which shows you just how serious this change in consumer spending really is. And in fact, we go back before 2020, during the 2010s, the silent depression, we only see consumer spending down on a 5-month basis one time, just the 5 months up to December 2018, the landmine. That's the only time consumer spending in real terms experienced a 5-month negative in the entire 2010s. Again, this is very serious. This is a clear shift in consumer behavior, and it started long before we got to tariffs. So no wonder companies are saying we don't want to provide guidance. They've already seen the weakness, and they know if it continues with prices rising, you get to the worst case scenarios. And that's reinforced by where a lot of this weakness is coming from, or really where it's pertaining to: services. Services, personal consumption expenditures for services in real terms, like the overall number, negative 3 out of the 5 months for 2025. And on the 5-month basis, services spending is basically flat, 0.1% increase, which is the lowest increase since July of 2020. Again, more proof that this weakness is real, and it's more proof that it's happening in discretionary spending, which is exactly where you would expect it to under these fragile, not strong or solid conditions. It's gotten to the point where even the mainstream media has had to say, oh yeah, this is worse than we thought. I'll give you an example here. Here's Bloomberg. The latest figures suggest sluggish household demand, especially for services, that extended into May after the weakest quarter for personal consumption since the outset of the pandemic. That's the first quarter. Spending on transportation services, meals out at accommodation, which Americans love, financial services, and other services, which is a category that includes net foreign travel, they all fell in the month of May. And the fact is, one economist put it, the May fall in personal consumption came after the revision to Q1 GDP, which also showed consumption weaker than originally reported. But the trajectory of personal consumption suggests that domestic demand was weaker and the economy less resilient than previously thought. Weaker and less resilient than previously thought by economists and central bankers, same thing. Not by the market, the real market. The market has been anticipating this breakdown in the economy the entire time. And so what started out early this year, they said strong and resilient, nothing to worry about. Then retail sales fell, and they said, oh, that's just a one-time aberration. But then it's just negative consumer sentiment. Consumers are overreacting to tariffs. They're afraid of something they don't need to be afraid of. But now we have evidence that shows it wasn't just sentiment. It wasn't just January. It wasn't just the first quarter. There is a material shift in spending because of incomes that is continuing here into the second quarter. And so what they're going to say now, shifting the goalposts, is, okay, yeah, we see this weakness, but wait for it, it's only going to be transitory. But all of these businesses, I talked about Winnebago last week with the GDP figures, all of these businesses throughout the economy are saying, as bad as it was back there, we're looking ahead. It's not, at the very least, it's not getting any better. And maybe the best illustration of that one final data point came from Chicago, the ISM today, the ISM Chicago Business Barometer, which unexpectedly declined here in the month of June. But the reason for the declines really perfectly illustrate this problem that the entire economy, from businesses to workers to consumers, what they're really facing. What the ISM showed and reported was in their press release, order backlogs softened by 1.5 points to the lowest level since May 2020. In fact, only 4% of respondents reported larger backlogs in June, which is the second smallest percentage on record and the lowest since 1980. So sales have been down for so long that companies no longer have any backlogs. This is the thing that we've been waiting for all this time. And with sales not picking up, backlogs that are continuing to be dwindled down, what that means is with prices rising on the input end, they only have one choice here, which is to cut back on workers in more extreme ways. In fact, that's the other part that the ISM noted in the press release. Prices paid climbed 8.3 points to the highest level since May 2022. 70% of respondents reported higher prices in June, up from 57% in May. So they're getting squeezed. No sales, no backlogs, higher costs, less employees. You got incomes that are going down. You've got spending that's already shifting. The economy's already weak. It's all evidence and holy grail evidence for the transition to the flat part of the Beveridge curve. Consumer confidence, not about tariffs. It starts with perceptions of jobs and incomes. And those jobs and incomes, consumers have been saying all year, it's getting weaker and weaker. And if that goes too far, meaning sentiment, then consumers will also pull back in spending. But as we see, it's not a future risk. It's already happening. It's not just anecdotes. We have hard data, the holy grail of macroeconomic data that shows something big has shifted in consumer spending already in 2025. The revised GDP figures for the first quarter showed that it happened back then and that it was zeroing in on discretionary spending, primarily services. And now the BE data for the monthly personal spending figures for April and May show that it continued. It wasn't just a one-off back in the first quarter. And not only does it continue, it seems to be getting worse. So the reason why FedEx or airlines and all these other companies really don't want to give their guidance is they know the longer this contraction in spending goes, balancing that against rising costs, it will mean a big jump in layoffs over the summer, over and above what we already see happening at the margins here in the second quarter. They all know it, but they don't want to say it. But the thing is, outside of the stock market and central bankers, they don't really have to. Flat Beveridge. Went over the details on the GDP revisions, as well as what Winnebago had to say about the spending environment moving forward in the video link below. As always, thank you very much for joining me. I hope you can join me on July 10th for our webinar. There's a link in the description to sign up. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.